Hey everyone, and welcome. Today, we're going to dive deep into a really important tax-saving tool in the new Income Tax Act 2025. We're talking all about Section 83, which is your go-to provision for handling capital gains when agricultural land is sold. So let's get right into it. Okay, picture this. A client walks into your office. They've just sold some agricultural land, and now they're looking at a pretty hefty capital gains tax bill. They're turning to you, the expert, for a way out under the new 2025 Act. So, what's your game plan?
Well, the answer, and honestly, your number one tool for helping clients in this exact spot, is found in Section 83. This section gives you a clearer path to tax relief. But, and this is a big but, it has some very specific rules and timelines. So, over the next few minutes, we're going to break down everything you need to know to use it like a pro. Here's a quick look at our roadmap. We'll start with the why behind Section 83, then we'll jump into the super important eligibility rules. We'll get practical with how to calculate the exemption, untangle the capital gains account scheme, and cover the must-know compliance points. And finally, we'll wrap it all up with the key takeaways you can start using right away. All right, let's kick things off with the basics. To really get a handle on Section 83, you need to understand its core purpose. I mean, why does this tax break even exist? And for those of us who've been around the block with the old tax laws, how does it connect to what we already know? The idea behind this law is actually pretty straightforward. The government wants to keep money flowing within the agricultural sector. So by offering this tax exemption, they're giving folks a big incentive to sell one piece of farmland and then reinvest that money right back into another. It keeps the capital working within agriculture. Simple as that. Now, for all you seasoned pros watching, this whole thing might be feeling a bit familiar. And you'd be totally right. Section 83 in the new 2025 Act is pretty much the direct descendant of Section 54B from the old 1961 Act. The main ideas, the mechanics, they've all been carried over. So, thankfully, it's a smooth transition for this really important relief.
Okay, so we've covered the why. Now let's get into the who and the how. Look, understanding these eligibility rules isn't just a formality, folks. It's the absolute first and most critical step. Getting this wrong means the whole claim is a non-starter. So let's break down these conditions.
So the very first hurdle is who can actually claim this. And Section 83 subsection 1 is crystal clear on this. This tax break is only available for an individual or a Hindu undivided family, an HUF. That means companies, partnership firms, LLPs, they're out of luck on this one, even if they're in the farming business. Next up, the land itself. Now, this is a super common point of confusion, so let's clear it up. Section 83 only matters when you have a capital gain that's taxable in the first place. A lot of rural agricultural land isn't even considered a capital asset, so selling it doesn't trigger any tax. This exemption is specifically for agricultural land that is a capital asset. Think land in or near cities, and crucially has been actively used for farming. Okay, this timeline is absolutely key. You've got to pay close attention here. First, there's the 2-year prior use rule. The land you sold must have been used for agriculture for at least 2 years right before the sale. Then, you've got the 2-year reinvestment window. From the day you sell, the clock starts ticking. You have 2 years to buy new agricultural land. And finally, the 3-year lock-in. You have to hold on to that new land for at least 3 years. If you slip up on any of these deadlines, the whole exemption could be at risk. Right, so you've checked the boxes. Your client is eligible, they've met the timeline conditions. So the next big question is, how much tax do they actually get to save? Let's get into the simple math of figuring out the exemption. The rule here is actually super simple, which is great. Your exemption amount is whichever is lower, the actual capital gain you made from the sale, or the amount of money you spent on the new agricultural land. It's a lower of situation. So you can never get an exemption that's more than your gain. And this table just nails the 2 ways this can play out. Let's look at scenario 1. You made a 50 lakh capital gain and you went out and bought new land for 60 lakhs. Since you reinvested more than your gain, your entire 50 lakh gain is exempt. Awesome, right? Your taxable gain is 0. Now, scenario 2. Same 50 lakh gain, but this time you only reinvest 30 lakhs. In this case, your exemption is capped at the amount you reinvested, that's 30 lakhs, which means you still have 20 lakhs left over as a taxable capital gain. So what happens if that 2-year deadline to reinvest is getting close, but you still haven't bought the new land by the time you need to file your income tax return? It's a common problem. Luckily, the law has a built-in solution for this exact situation. So, Section 83, subsection 2, gives you a way out. You can basically park the money.
If you haven't reinvested by your ITR filing due date, you need to deposit the amount you plan to reinvest into a special capital gains account scheme, or CGAS, at an approved bank. This tells the tax department, hey, I intend to reinvest, and it lets you claim the exemption on your return. But, and this is crucial, you still have to buy the new land within that original 2-year window. If you don't, whatever money is left in that account becomes taxable in the year that 2-year period ends. Following the rules is one thing, but proving you followed them to the tax officer is a whole other ballgame. Let's talk about the practical side of compliance. How do you build a rock-solid claim, and what are the common traps that can catch people out? So what's the bottom line here? It all comes down to documentation. Your paper trail has to be perfect. That means you need the registered sale deed for the old property and the purchase deed for the new one. You absolutely need land records to prove it was used for agriculture for those 2 prior years. If you use the CGAS, you need the deposit slips and passbook. And of course, you need bank statements to show the money moving from the sale into the new purchase. If even one of these is missing, your entire claim could be in jeopardy during an audit. This brings us back to that 3-year lock-in period we talked about. This is a really common tripwire. So what actually happens if your client turns around and sells that new piece of land before the 3 years are up? Well, selling that new land too early triggers what's called a clawback. Basically, the tax benefit you got, it gets pulled right back. That capital gain that was originally tax-free is now considered taxable income in the year you sell the new land. It's a strict rule, and it's there to make sure people are genuinely investing long-term in agriculture, not just flipping properties for a quick tax break. Okay, we have covered a ton of ground. So let's boil it all down to the absolute must-know points from our deep dive into Section 83. Let's run through the essentials one more time. First, who's it for? Individuals and hoofs only. Second, the prior use rule. Remember those 2 years of agricultural use. Third, reinvestment. You've got a 2-year window. Fourth, how much you save. It's the lower of your gain or your new investment. Fifth, the lock-in. You've got to hold that new land for 3 years. And finally, your safety net. The capital gains account scheme is your best friend if you're running short on time. And that is a wrap on our deep dive into Section 83. I really hope this breakdown was valuable for you and your practice. If you found it helpful, do me a favor and hit that like button, subscribe for more explainers on the new Income Tax Act, and hey, feel free to share it with your colleagues. Just a quick reminder, this video is for educational purposes and shouldn't be taken as professional advice. Tax laws are always changing, so it's really important to consult with a qualified professional before you take any action. Thanks so much for watching.